Welcome back. The Reserve Bank has kept the repo rate, the benchmark interest rate that it lends out to the main commercial banks, unchanged. That was expected. So that means if you are in debt, if you hold a bond, etc., the prime interest rate stays at 10.5%. But there was a lot of interesting detail around that decision today. And to discuss, I'm joined by Elize Kruger from NKC African Economists and Mamello Matikinca, and she's from FNB. Thank you so much for joining me. Mamello, let's start with you, and I'd like a comment from both of you. It sounds like there is a change in tone. We were talking about possible interest rate cuts a while ago. He's hinting that maybe inflation could change things. Do you agree?
100%. I think what was surprising from that statement was that upward revision in inflation to 6.2%. So initially, well, last year at least, the SABC had said to us, look, we think we expect inflation to return within the target in the second quarter. So now they expect inflation to remain above the upper end of the target for a longer period of time. But interestingly, even though the inflation profile is not returning within the target as anticipated or as quickly as initially thought, it does seem as if they're really concerned about growth. He highlights that growth is well below potential. So it does seem as if, even though they're not explicit about it, they are really concerned about economic growth.
Let's come back to that, but your comment on inflation, he's talking about it only coming within that band of 3 to 6% in the fourth quarter of this year now.
Yes, if you remember correctly, in November last year, the bank has kept a bit of a backdoor open in the very last sentence of the statement, saying that they do see the risk to inflation to be moderate to the upside, and if the risks would materialize, they would reconsider the view that they are close to the upper end of the interest rate cycle. And with the December inflation curveball, I want to call it, it was really a curveball in the sense that both food inflation surprised at the upside, as well as a few other factors simultaneously resulted in that spike to 6.8, and that has changed the story, as the starting point for the inflation forecast has moved quite considerably higher than expected. A difference between a 6.5 and a 6.8 is quite notably. So that has lifted the whole curve for looking forward. I'm not surprised to hear that they're going to look through it in the sense that, yes, food inflation is still expected to decline gradually, and they see the longer term view. And it's heartening to see they stick to that in the sense that always they tell us they look forward by 12 to 18 months. Lesetja even mentioned 24 months today. So yes, this is a short term deterioration, and I'm glad that they didn't punish the economy by say hiking rates today because of this deterioration in CPI, because a 0.4 on an annual average is quite a big adjustment for the central bank. But they said, it's a short-term deterioration. Looking forward, they're still comfortable that we will see inflation coming down.
Well, he did suggest, what you picked up on at the end, was that basically the bank is holding back. It could actually push rates up because of inflation, but it does care about growth. And this is so interesting because I remember for the past few years, a lot of debate around the mandate of the bank. And he was saying we're being accommodatory, really outlining how he sees the mandate. Did you find that interesting?
It was quite interesting, but I think what gives him a level of comfort is that inflation expectations are lowering. So generally people are expecting prices to decline quite well later on this year. And I think as well, he does say that, look, the rand has stabilized, and that should offer some support to the inflation outlook. And also remember, Stats SA is going to release that new inflation basket, so there could be some adjustments there. And I think that the fact that core inflation, their forecast for core inflation hasn't changed, gives them enough justification to say, look, even though inflation is high, we're going to keep rates steady, and of course, but not indirectly saying support the economy. They did lower that growth forecast, as I mentioned, to 1.1%.
Elize, do you agree? So no change in stance, really. I mean, the bank used to say we don't target a level of the rand, but he was talking about the rand a lot. How did you see what he was saying?
Yes, I think they are very thankful for a stable rand exchange rate at this point in time. If it wasn't for the rand so strong and so stable over the past few months, I think the whole story would have been, notably different. So yes, the rand is definitely helping on the inflationary side. As we import our products, we pay less for that with a stronger rand, and also the stable rand is quite positive for the economy. I mean, the fact that the rand remains at 13.50 on average compared to maybe a Big Mac indication of below 6 or something, it's still positive for this economy because it helps us on the export side. It helps us on tourism. We also needed growth impetus come from. So I think if we have a stable rand, that is just as positive, even at these levels compared to just a strengthening rand.
That 1350 level, like you say, maybe we should be grateful given the volatility since the US election. The rand hasn't performed that badly, but he was talking about the threats and Trump. What did you think about what he said?
You know what, I think the uncertainty surrounding the Trump presidency and policies that he's going to implement is a huge risk for the rand. We've seen repeatedly that our rand does take a cue from what happens in the US. And I think if we look at what the market is saying is that essentially expected fiscal stimulus in the US is going to be positive for that economy. But at the same time, the risk is that inflation could increase quite aggressively in the US. And if that happens, the Fed will hike rates more aggressively and we end up where we were last year. So although it has stabilized, we have to wait and see what the implications of the policies that Donald Trump is planning to implement are going to be on the rand.
Is Trump the possible wild card for all our plans?
Definitely so. I think, for the global economy, as a whole, it's a big uncertainty as to what will happen and what will be the impact on the global economy. And also, the ramifications for us. Although our trade with the US is quite small, it's more a question of we're part of the emerging market universe, and if what's happening in the US and the impact on the global picture is negative for emerging markets, we will also feel that. At NKC, we also expect that the dollar will strengthen further. We're talking about parity against the euro by the end of this year. And if we're looking at that type of levels, you do look at a weaker rand environment towards the end of the year.
The dollar keeps getting stronger, but Trump himself seems to want a weaker dollar to boost American exports. Does he have any control over that, do you believe?
I don't think any control per se. I mean, he can talk the currency, up or down, or try to talk that. But I think the market positioning, is at the moment already indication that, they do expect the dollar to be stronger in the environment of the policies that Trump talks about, in terms of, high economic growth in the US, like you just mentioned, high interest rates, more capital flows to the US will result in a stronger currency. So even if he talks it weaker, if, the rest of his actions result in a stronger dollar, the impact will be felt globally.
Okay, so we're now in a position where the bank in future could go either way, basically. Inflation is what's going to change things. And he was talking about Brent crude oil, the deal that's pushed oil prices up. He said that's a bit uncertain, but I think we know that prices will remain capped. Do you think that's a big factor this year?
Look, I don't think so, because I think our assumptions are relatively more or less in line with what the SAB is saying in terms of the oil price. I think where the big swing factor is, and I think that there was no mention in it in this budget speech, and we'll probably get indication of it probably in the months that are to come, probably next month, is core inflation. That's what I would be worried about. And I think if core inflation does move up higher, there is risk for them to actually tighten interest rates. And I say this because if you look at medical aid costs, currently we have that penciled where we expect a double-digit increase, and from what I'm picking up from the SAB, it seems as if they're not that aggressive. So if that does transpire and you see a core inflation rate that increases or hugs the upper band of the target for a prolonged period of time, and I think in that situation then we could be looking at possible
all right, so it sounds like you think that could happen even this year. I'm going to ask you both to give me a possible scenario for this year.
I mean, look, we're looking at interest rates remaining flat for this year and next year. We think the possibility of a rate cut is out of the question. And this is because we are in an interest rate hiking cycle in the US. And as we've just discussed, that the risks to the rand, which seems as if it's the one thing that's helping the inflation outlook, if I may put it like that, the risks to that remain quite high. And I would also just highlight that core inflation, I think, could also be a potential risk. And we'll get more indication of that probably sometime in March.
Okay, let's come back back after break, and then I'm going to ask you for your prediction, because we will have a little bit more chatting time and we can talk about core inflation and food prices. Stay tuned back after this.